Welcome to Talk Tickers, where we break down the earnings calls that really matter. Today, we're diving into Whirlpool's Q3 2025 results. Now, the headline numbers looked pretty good, but the real story is what's happening just under the surface. So let's get right into it. Right out of the gate, the stock popped over 5% pre-market on this release. So you gotta ask, what did the market see that it liked so much? Let's unpack this better-than-feared reaction. Okay, so here's the big number everyone's talking about. Whirlpool delivered ongoing earnings per share of $2.09. Now, to put that in perspective, the consensus estimate was just $1.39. So they didn't just beat it, they absolutely smashed it by a full 70 cents. That's huge. All right, here's how we're going to break it all down. We'll start with the Q3 earnings snapshot, then we'll get behind that top-line beat. After that, we'll dig into the margin and cash squeeze. That's the tricky part. Then we'll see what management's playbook is for the future, and we'll wrap it all up with our call on the road ahead for Whirlpool. Let's do it. First up, the Q3 earnings snapshot. Let's get right into those headline numbers and see how they stacked up against what Wall Street was expecting. And as you can see, it was a solid beat on both the top and the bottom lines. Revenue came in at $4.03 billion, a good $100 million ahead of what the street was looking for. Now, that's just 1% growth year over year, but hey, a beat is a beat. But like we said, the thing that got everyone's attention was that massive 70-cent EPS beat. So where did this outperformance actually come from? Well, it really boils down to one simple but powerful idea: product momentum. And look, you don't have to take my word for it. The CEO, Mark Bitzer, he made it crystal clear on the call. He said, and I'm quoting here, "We have the largest number of new product launches in North America in over a decade." So that's the engine right there. This huge product refresh is driving the whole thing. So let's get into the nitty-gritty. First, their major domestic appliances in North America, your refrigerators, washing machines, sales there were up a solid 2.8%. But the real star of the show, their small domestic appliances. Think KitchenAid mixers. That business was up a whopping 10.5% globally, and that's all thanks to a really successful redesign and getting more floor space in stores. Really strong stuff. Okay, so the top-line beat sounds great, right? But it's only half the story. Now we need to talk about the other side of the coin, the margin and cash squeeze. This is where things get a little complicated. And this right here, this slide perfectly illustrates the core problem. On one hand, you've got revenue growth, up 1%. Great. But on the other hand, look at their ongoing EBITDA, their core profitability. It fell by almost 23%. That is a massive disconnect. And when your profits get squeezed like that, it has a direct and, frankly, severe impact on your cash. In just this one quarter, Whirlpool burned through over $900 million in free cash flow. $900 million. So the big question is, why? Well, according to management, the key culprit is something called competitor preloading. Here's the deal. Foreign rivals knew U.S. tariffs were coming, so they rushed to import a massive amount of inventory from Asia before those tariffs hit. They just flooded the market. And you can guess what happens next, right? It created this crazy promotional environment, basically a price war that crushed margins for everyone, Whirlpool included. All right, so given these pretty intense headwinds, what's the plan? How does management plan to right the ship? Let's take a look at their go-forward playbook. They're basically focused on three main catalysts for growth. Step 1, keep that new product momentum going. Ride that wave. Step 2, leverage their U.S. manufacturing advantage. This is huge, because as tariffs hit their foreign competitors, Whirlpool's U.S. footprint becomes a massive strength. And step 3, they're positioning themselves for the eventual recovery in the housing market. And you can see this whole story reflected right here in their updated full-year guidance. They're holding the line on sales and EPS, but, and this is the key part, they've had to revise down their expectations for profit margins and free cash flow. They're acknowledging that the short-term pain is real. Okay, so let's put it all together. The good, the bad, the complicated. What's our call on the road ahead? What is the Talk Ticker's verdict on Whirlpool? All right, our equity rating is market perform. Look, here's the thinking. On one hand, you have this really powerful company-specific story with their new product momentum. That's a huge positive. But on the other hand, that positive is being completely offset for now by that severe margin pressure and a ton of uncertainty about when these tariff edicts are finally going to clear up. Okay, but before we wrap up, it's time for our favorite segment, the wild but plausible trade. This is a hedge fund style idea, maybe for those of you with a higher tolerance for risk. Let's get into it. So the idea here is a pair trade. It's got two parts. First, you go long Whirlpool, specifically mid-2026 calls. This is your bet on their self-help story. The thesis is that by the first half of 2026, all that preloaded inventory will be gone, pricing will firm up, and their margins will recover. But at the same time, you go short the consumer discretionary ETF, the XLY. This is your hedge. It protects you against a broader slowdown in consumer spending. It's a pretty clean way to play their unique turnaround story. And as always, just a quick reminder, this is for informational and educational purposes only. It is not financial advice. So please always do your own homework before making any investment decisions.